Good morning, everybody, and welcome to this month's IFRS and Corporate Reporting webinar. Now, this month, we're talking about a very topical and relevant aspect, which is accounting for power purchase agreements. So, exciting one today. Today, we've got all three our partners presenting. So, I'm joined by Kevin Frobers in Sydney. Hello, Kevin. Lovely to see you.
Hello, Alette, and it's good to be back. Sorry for not being around last month, so it's really nice to be back in the hot seat with you both.
No, it's good. We all need to at sometimes do other things, Kevin. So, a rotation is good. But welcome back. And then again, as last month and in January, Dean Arden is joining me, a fellow partner here in Melbourne. So, morning, Dean.
Morning, Aletta. Morning, Kevin.
Now, BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. And we pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples here. I just want to flag again that we've got these monthly IFRS and corporate reporting webinars for our clients. Of course, today we're looking at accounting for power purchase agreements. And then next month we go back to an old favorite, common errors in applying AASB 16 leases. Absolutely amazing that we continue to speak to so many clients about how do they do that technically, but also what's the technology that could assist them. And then another interesting one on the 22nd of October, accounting for Australian carbon credit units, somewhat related to sustainability, similar to today's session. Our monthly sustainability webinars, this month, actually next week, we're starting with a deep dive into AASB S2 climate-related disclosures. So our session next week is a whole 1 hour focusing on the governance aspects of climate-related disclosures, and you'll see the rest of the year that deep dive on AASB S2. Our carbon accounting masterclasses are continuing to storm the nation. So tomorrow we're doing the virtual masterclass, a large number of attendees, and you're not too late if you still want to register. You can register for that. But then on Friday, Ashley Woodley is presenting a masterclass in Perth. Next week, on Tuesday, Kevin and Tom Dart is presenting a masterclass in Sydney. Super excited about that one. And then on Friday, Tom Hogben in Brisbane rounds out the March carbon accounting masterclasses. But watch out, we will be back. They continue to be extremely popular as people are starting to get ready for mandatory reporting. So that's just another one on the carbon accounting masterclasses. Before we do a deep dive into power purchase agreements, I was thinking last night, so why on earth did we schedule this session? Why would people come and listen to accounting for power purchase agreements? And it goes back very much to what we do in AASB S2 climate-related disclosures. We know AASB S2 mandatory for years beginning on or after 1 January 2025 for Group 1 entities, those large entities. But if you look at AASB S2, there are 4 pillars of disclosures, and the 4th pillar talks about metrics and targets. And one of the key metrics is measuring and disclosing your greenhouse gas emissions or GHG emissions, meaning scope 1, scope 2, and scope 3. Again, scope 2 emissions are indirect emissions. So that's emissions that would happen at the power plant as they generate electricity, for example. But you bring it into your carbon footprint and into your emissions boundary when you purchase and use that electricity. So it's an indirect emission. In Australia, the only scope 2 emission we have is purchased electricity. And then the greenhouse gas protocol talks about you measure your emissions associated with purchased electricity, scope 2 emissions, with two methods, a market-based method or a location-based method. So location-based method, I would say the easy one. In Australia, we've got emission factors for every state. So if you know what your electricity usage is and you can apply your location-based emissions factor, you know what your emissions are. But there's also a market-based approach. And by the way, market-based approach, location-based approach are both mandatory disclosures. But market-based based approach is saying, what have you as a business done um, to minimize your emissions from scope 2? So maybe you've been more efficient um, and used less electricity. That could be a way, but market-based reflects the fact that maybe you've gone out and you've purchased renewable energy. So you haven't just purchased the location from the grid. You've gone and you've paid extra to buy renewable energy, and you can do that in various different ways. And power purchase agreements is but one of them, and we'll focus on them because they're used so commonly. Um, the next point that I want to make is a lot of businesses are looking at decarbonisation initiatives. And decarbonisation initiatives really in the first instance focus on scope 1 and scope 2, because scope 1 is under your control at entities and assets you control, and scope 2 you can, I would say, influence greatly by your usage and whether you are entering into power purchase agreements or not. So a lot of businesses are starting with scope 1 and 2. It's the easier ones to decarbonize. It's also the first ones where we have to do mandatory reporting. Scope 3 comes a year later. So decarbonization initiatives at a lot of our clients and target setting focused on scope 1 and 2. And then I think finally, a really important point is we know that there's a lot of concerns in the broader economy around costs. There's cost pressures. And there's also concerns around the cost pressures of buying green or renewable energy. And again, power purchase agreements is a mechanism that you could use to alleviate those cost pressures. So absolutely, power purchase agreements, super important for sustainability, for managing costs. And that's why we're looking at it. Ultimately, as always, with a number of things businesses do, there's the commercial reality, why they're doing it. Then there's also maybe they're doing it for strategic sustainability purposes. But please do not forget the accounting reality that will be reflected in your financial statements. And we want to round that all out today by talking about that accounting reality. Understanding there are strategic reasons for doing it, understanding that there are commercial reasons for doing it. So today's agenda, Dean will be presenting most of it, looking at Australian electricity markets. Have to understand that before you look at power purchase agreements. Then we look at some of the accounting implications. Kevin will be looking at embedded leases. Dean will then come back to look at embedded derivatives, hedge accounting. And we'll also look at anticipated future developments. We will share some BDO resources. And then right at the end, hopefully we have some time to have a bit of a fun discussion on accounting position papers. So looking forward to that as well. So at this stage, Dean, I'll hand over to you.
Thanks, Leda. I'll caveat what we're all going to say in the next 3/4 of an hour by saying we're really only going to be focusing on those parts of the Australian electricity markets that are relevant to the accounting. So we're not trying to give a complete description and a complete explanation of the entirety of the Australian electricity markets. We're really just focused on those parts of it that are relevant to the accounting. And so we'll start off by having a look at some of those fundamental features of the electricity grid. Tongue in cheek, I'm glossing over the complexities. I thought that was a really good little picture to summarise exactly what the physical grid, the electricity grid, looks like in Australia. But the key point to make there is actually a missing thing, and the missing thing is the market operator. It's important to remember with electricity, it's not unlike lots of other goods. It's neither tangible or intangible in some ways. It's an interesting product. It's hard to assess in terms of control passing without meters. It has all sorts of features that we don't necessarily deal with otherwise in accounting, so that makes it a little bit challenging. What's missing out of that diagram is the role of the market operator. If you looked at that diagram, it would make you think, okay, it looks like a set and forget type arrangement. But the way the electricity grid works, and there's multiple grids in Australia, but the way they work in Australia is they have an operator that manages the supply and demand. Now, if they don't have somebody managing that supply and demand, then effectively you need to be able to and manage that in such a way as to ensure that the grid doesn't become unstable. So if you get too much supply, then sometimes those generators will they'll take themselves offline. If you get too much demand, then you can get blackouts. Consequently, they need an operator that there's managing it all the time. Now that's important because that does change the way that transactions within the market occur, particularly in the wholesale market. So if we now move to that whole Australian wholesale electricity market, the market in Australia is physically divided up basically into three markets. You might ask yourself, why is there three markets in Australia? Australia does, we've got markets that one particular market runs over a couple of states. The reason is that physically it's very hard to push electricity around without losing power. So as a consequence, often there is limitations and they're physical on what a market can be. So we have three markets in Australia: the National Electricity Market, the NEM, which is effectively the east coast of Australia, plus Tasmania, plus South Australia. It's operated by the Australian Energy Market Operator, which manages both the physical power system and the wholesale and retail markets. It comprises about 300 plus registered participants. Now, when we talk about registered participants, this is again what the market operator does, because the market operator only deals with those registered participants. To maintain the stability of the market, the operator can only have, must be able to see and understand and deal with the registered participants. They can't have people feeding in and taking electricity out of the grid that they're not aware of, because that effectively undermines the stability of the grid. So in Victoria, and I've listed those in order of, I suppose, in order of how much they contribute to the electricity in Victoria: black coal, brown coal, wind, rooftop solar, grid solar, hydro, gas. So we get quite a range of sources of electricity. I've mentioned there at the bottom of each column the maximum daily demands, but that's just to give you a context of maybe the sizes of the relative markets. Those demands, I think, might be a little bit out of date. I think they were like 2024 or 2023, so there might have been some changes in the quantities of demands that have occurred over the last 12 months or 18 months. Moving on to the wholesale electricity market, that's effectively Western Australia. It's a slightly different market, still operated by AEMO, and they do manage the physical power structure in the markets, but they also operate a short-term energy market, which is effectively a futures or a short-term purchasing market. And they also have a reserve capacity mechanism, which ensures that Western Australia doesn't actually run out of electricity at any point in time. There's about 90 registered participants. They get similar sources of electricity. Northern Territory, effectively Northern Territory covers all of those people that are involved in the Northern Territory: the physical power system, the wholesale and retail markets. It's run by NTEMSO, but it's actually managed by Power and Water Corporation. So there's a slight split between the responsibilities there. It's got over 300 registered participants, so it's very large in terms of the number of participants. And the sources of energy, generally gas. Gas is a very, very prevalent use generator of electricity in Northern Territory. Biomass, steam, rooftop solar. If we move now on, I think we've got a poll question next, I think, Aletta, do we? So we've got a poll question just to give a sense of where people are in terms of the listeners. Where do you currently acquire your electricity from? Is it from the National Electricity Market, from the Wholesale Electricity Market in WA, or is it the Northern Territory Market? The reason why I was sort of asking about this is to get a sense of exactly where the listeners are and exactly the kinds of things that they're doing. Like I said, the markets are all very similar to some extent, but there are some subtle differences. So it's helpful for us to actually understand those differences.
Dean, it's also important to understand where you're getting your electricity from, because when you do your carbon emissions factors, you need to know which factor to use. All the mix of electricity and the sources of, coal, gas, and so forth are all different.
Yep.
And so, more and more, as you'll see with the webinars we're doing, you need to know more than just the financial implications of your business. It's where is your electricity coming from? That'll drive things like your treasury decisions, but also your carbon emissions factors. So it all does link in the end.
Spot on. Thanks, Kevin. I think the numbers are stabilised now. It looks about just over 80% in the NEM, approximately 15-16% in the Western Australia, and a couple of people, I got 4 people in Northern Territory. That's good to know. Thank you for that. Lida, do you want to roll on to the next slide? Managing markets for electricity supply and demand. I'll go back to my original caveat of saying we're not talking about all aspects, and I think what I'll do is also caveat by saying these are gross descriptions in the sense that they're sort of broad descriptions used to categorise markets generally. The markets, and it's been used by the standard setters as a gross pool electricity market and net pool electricity market. These concepts are just simply to give an idea about how the market works. Having said that, you would find that in these markets, there's probably some relationships which don't represent either gross or net. So for example, in the gross market, you might find that there's some direct lines between generators and users. But in terms of the general grid, then those classifications are just useful. Again, we're using them really to sort of articulate exactly maybe the way the standard setters are looking at this and how they've got to the conclusions that they've got to, rather than necessarily some kind of fundamental classification for any other purpose. So gross pool electricity market is, as the name implies, everyone basically puts their electricity into the market and then takes it out of the market. So the grid is like a group mutual arrangement effectively then, and metering is used to basically determine who pays and who's acquired. All transactions are settled at the spot price via the market operator and acts as a clearinghouse for all of those transactions. And generally, Australian markets are the group pool electricity markets. Net pool electricity markets, not as they're more common. You find them in places like India and America. They're effectively a form of direct sales between parties. But if there's any extra leftover electricity, then that's pooled and sold as a separate pool at spot rates. I think the key thing to realise with all of these is that there's always going to have to be some outlet in terms of the quantity of electricity. So if we've got more electricity than we need, it has to go somewhere. You can't just, it doesn't necessarily sit anywhere. And if we're talking about large volumes that are pushed through the grid from various generators, then often we don't have the capacity in terms of storage or batteries to necessarily take that. So it's very much a case that whatever's in the grid has to be managed at the time and has to be dealt with, rather than necessarily just simply stored. So unlike other types of inventory and assets that we talk about, electricity is different in that sense. It has to be used otherwise, particularly within a grid, otherwise it's difficult to manage. We might move now on to actual purchasing power agreements. Alena? So I've got a slide there that's describing what are PPAs, who has them and why have them. The what contracts, they are effectively just contracts. They're like supply contracts. To that end, I might just mention too, a couple of people asked us if we could share copies of PPAs, and I obviously we can't share documents that are provided us by clients because of privacy reasons, but what I did do is have a quick look through, and I've provided some references further into the presentation of actually template PPAs. But what I would say about PPAs, they look like a lot like all supply contracts. So they have probably about 80% of the terms are sort of consistent with what you'd see in other supply contracts. So you see things like the term of the agreement, the timing and payment terms. You'll see things like confidentiality, you see things like GST, you see things like jurisdiction. So they look very much like a supply contract, and typically in this case, there might be between the original, and depending on whether you're wholesale or retail, could be between the customer, it might be a retailer or an ultimate customer, and between a generator or actually a wholesaler. So it can be various parties that are involved. And it may not necessarily, and as a consequence of that, you might find some differences between them, but overall, really, we're talking about a supply contract, so it has those types of features. The buyers can include individuals, businesses, buyers groups, government, public sector entities, and sellers can include both energy wholesalers and retailers. And so keeping in mind, I suppose I've alluded to it now, we've actually got both a wholesale and retail markets. Why? Well, generally is, I think everyone's aware that energy prices are going up, and that there's also the demand that certain entities have for carbon credits as well. So as a consequence of these agreements, effectively entities are looking to, on both sides of the transaction, so trying to look to stabilise their prices, but at the same time trying to lock in sort of revenues if you're a supplier of electricity going forward. It also ensures to help you if you are looking to acquire carbon credits, then it's a way of actually doing that as well. Obviously, the only carbon credits would be associated more with the renewable energy contracts, not necessarily with your standard contracts that are necessarily driven by other, for example, other sources of energy. If we move on to the next one, wholesale. So I alluded to it just before, wholesale market. Maybe premise that this is that I mentioned before that the idea that the operator has to be aware of who are in the market. So who are the parties providing electricity and who are the parties acquiring the electricity, because if they can't monitor and manage those things, the grid will become unstable. So as a consequence, we have effectively two markets, wholesalers and retailers. You imagine the wholesalers are the ones that are acquiring large scale electricity. They might be passing it on to generally retailers, but there might be other people within the market or other entities within the market that are registered entities, but they're not necessarily retailers. So they might be large consumers. And this is what this diagram is sort of demonstrating, is the idea that it could be a retailer. So somebody who's actually going off and selling electricity to individual houses or individual businesses, or it could be to somebody who's a registered participant who uses a lot of energy. So imagine like an aluminium smelter or something similar, some type of entity or company or business that uses large quantities of electricity. Generally, when you're talking about the wholesale market, you're talking about consumers of 60 gigawatt hours per year plus. So you're talking about large consumptions, and obviously the types of industries tend to be on that side. So mining, heavy industry, large commercial businesses, and data centers is also an area that's really strong on consumption of electricity. Moving on to the retail purchasing price agreements. Again, typical arrangement. It sort of looks a little bit like a wholesale arrangement, but you've got a second level in there in terms of the retailer. Typically, the retailer won't be wholesaling themselves, but they might have some, in some contexts, might have it. But typically, the wholesaler will be sourcing from the generator and sourcing from sources, selling to the retailer. Those two parties themselves might be contracting. Now, they'll contract through the market, but they then, in turn, the retailer will then contract with individuals both possibly in and outside of the market, because the retailer might find themselves that they have energy that they can't dispose of. Usually in the retail market, over 5 gigawatt hours per year is the kind of level of consumption. It's a step up from the standard consumer electricity contract, like the contracts that you and I have for our houses. It doesn't look anything like that. Typically, there'll be some pricing mechanisms in there that ensure that there is some price protection if you're buying bulk and you're buying over long periods of time. Move on to the next slide, the broad categories of purchasing power agreements. I just wanted to sort of highlight that when we actually get to purchasing power agreements, often they look similar. I mentioned before that they've often got very, very similar features and characteristics, but they can be divided and should be divided for accounting purposes between effectively wholesale and retail. And when you look at wholesale and retail, obviously you're looking at different types of volumes, but you also might be looking at different pricing mechanisms. And that's ultimately what's driving a lot of the accounting issues around these issues, around these contracts, is how do you deal with those pricing issues? You can further divide those PPAs into both physical and virtual. So a physical one is, as the name implies, is that, and again, it's a little bit misleading, but the idea is that implicitly the customer is actually going to take the electricity. Now, they might, if you're feeding it through a grid and it's a group pooling grid, then you don't get the electricity necessarily that the retailer has purchased. You might be just getting electricity, but it's a fungible good. But you are taking consumption of some electricity. You're taking it under that contract. A virtual one is effectively a contract for difference. Now, the purpose of a virtual one is to ensure that you're protecting yourself from the price, notwithstanding that you might not actually physically take control of that electricity or any electricity. And this is where the challenges that come in accounting is that the requirements that apply to derivatives are probably not written, or weren't written, and probably not particularly subtle in a way that they're applied here, because they don't really make a distinction between a situation where somebody physically takes the electricity or decides not to take it, or actually just is never going to take it. I'll come back to that point, but I suppose that's probably one of the key things that's posed a challenge for the standard setters over the last 12 to 18 months. I'll just mention there too that they've got the behind the meter PPA. Now that's a situation where you might actually have an actual power facility actually on your property, but it's not actually run by you. Now it's not unusual; they're relatively common, but as a consequence, they look much more like a physical one because effectively the electricity being generated on your property, you generally will be paying for that electricity, but you're actually physically taking that electricity to be used. If we move on to the next slide, common contractual terms. I mentioned before that there's lots of contractual terms in PPAs that look similar to any other supply agreement, so they're very nondescript. The two particular types of contractual terms that really cause the challenges for accounting are the pricing terms and the quantity related terms. Now, in terms of quantity related, you can get all sorts of, and look, the market is growing, you can start to get all sorts of contracts and contractual terms that are modified and adjusted for the particular parties involved. Probably a long time ago that we were just talking about fixed quantities and fixed prices, or fixed prices with escalation, or just simply spot prices. Now, when we're talking about quantity, we can get fixed load shape. So the idea that you can negotiate with the supplier to say, well, my peak and off-peak times look like this, and so as a consequence, that would shape the quantity I purchase. You could just simply take a percentage of production of that, the supplier or the facility, or you could have a load following arrangement, which again, it's very, very bespoke and negotiated between the parties to ensure that basically the customer is receiving what they need. As you'd imagine, as it becomes more detailed, those contracts become more expensive to administer. Similarly, in terms of the pricing, you can have variable, you can have fixed, you can have an escalation, you can have a combination of those. We're starting to see, and I'll mention it probably a little bit later, we're starting to see some interesting ones around agreements which give the customer some flexibility in the timing of when they set in prices and when they actually lock those in, or whether or not they continue to accept a spot price. I think that takes us on to, I think we were going to talk just to that. We were going to run a poll question, but I think we might leave that one at this stage allow. We might just move on to the next slide on the examples. I mentioned before that we were asked if we had any PPAs that we could share. Like I said, for privacy reasons, we can't share them, but they're not hard to find on the internet. So a very, very quick search of the internet, you can find all sorts of example templates. I'm not advocating or promoting any of these. These are ones that I've found from a random sample. There's a broad range of them. You can find them from various countries. I noticed that the UK has also got ones that you can actually think. Like I said, if you look through them, you'll find that the features are quite common. They don't look different, and certainly they have lots of features that are quite similar. Probably the key differences from contract to contract are the terms around quantity and the terms around price. I think that leads us to accounting for the embedded leases, Kevin, which I think you were going to talk to.
Thanks, Dean. And I have to say, I think that probably is now one of the best summaries of the electricity markets and at least the base introduction for accounting considerations. So, Dean, I think you're a superstar in terms of that
Thank you.
summary, and I think this is going to become the webinar of choice to kind of bring this all together. Why I'm doing this section is probably to give Dean a chance to have a sip of water, but also to kind of take a step back and say, well, how do we actually start to apply this in the accounting? And one of the first steps that needs to be considered, and one of the first steps that is often missed, is whether there's actually an embedded lease in the contract. Now, how this works is it actually fits quite nicely into the mechanism in which the accounting standards that apply to these contracts were developed, and they're all contractual, which means our three contracts are revenue, financial instruments, and leases. For those of you who've been on this journey with a letter of 9, Dean, for years, with the new accounting standards, IFRS 15, revenue recognition, leasing, and so forth, the concepts are all still the same as they apply to PPAs or power purchase agreements. It's just the complexity that changes, and there's a lot of complexity, but you still need to think about it in the same way. You need to understand the contract, understand the complexity, break it into components, And one of the first things is then to answer, do I have a lease embedded in here? Doesn't mean the whole contract's a lease. It could just mean that a component is a lease. And that's why this is the first part of the accounting considerations. Now, often we don't end up with a lease, but you still need to go through that consideration, because if you do have a lease, you've got to carve that piece out and account for it as a lease. So that's the first sort of context behind it, is do we have an embedded lease? And I think you can see where the lease pops out. It's if I'm taking all the offtake of an agreement, or if I'm taking the offtake but also getting all the renewable credits that come with a wind farm or a solar farm, don't I just have a lease over the solar farm? That's the key question. Of course, there's variations and complexities on that, but that's the sort of underlying concept is, well, actually, um, aren't I just leasing the underlying facility that's generating electricity? Of course, however, it's a lot more complicated than that. And you can see from the introduction that Dean gave us, questions about the purpose and use of electricity, who the counterparty is, what's the infrastructure necessarily to deliver it, who the market operator is, whether it's a gross pool or a net pool arrangement. Did I take this out as a derivative over pricing? Am I operating as a virtual or a physical PPA? And lastly, am I in a wholesale retail contract? All of that stuff is actually relevant to the assessment, which is why you need to understand all of that before you can actually do the lease accounting assessment. And as you'll see with the rest of the presentation that Dean will take you through, you need to understand all of that to actually ask yourself questions about derivative and hedging, which comes next. But I'll run you through very quickly at least one example which we now have that went to the International Standard Setter, or at least to the Interpretations Committee in 2021. It's quite a while ago now, but it is a good example to kind of show you how their thinking was applied to, do I have a lease? I'll start with the fact pattern in the middle. I won't spend too long going through this, but essentially in the middle column of the slide that's down there is kind of the fact pattern. We have an electricity retailer who's entering into agreement with the wind farm. The retailer is the customer, the wind farm is the supplier. It's a 20-year term, and the supplier is swapping the spot price per megawatt for the retailer with a fixed price. So it's essentially it's fixing the price, or it's a pricing mechanism contract. But also importantly, and this is really important to your assessment, is all the renewable energy credits that go with the wind farm with the supplier will also go to the retailer. This is pretty common in Australia, as you will see. This fact pattern that went to the International Interpretations Committee didn't just have the basic fact pattern in the middle column. It actually also had the fact pattern on the left-hand side, which is what sort of market I'm operating in, which was a gross pool electricity market where the parties are unable to actually enter into direct contracts with each other for the physical supply of electricity. So that means we're working with a virtual PPA here. So the retailer is not buying electricity from the supplier, and their spot prices for the physical delivery actually being set by the market operator. So if you apply this to Australia, your market operator would have probably been MEO. Now, this is not an Australian question. This is an international question. Actually, to be fair, I can't actually recall if it was an Australian question or not, but it was meant to be a neutral question where there was a fact pattern which wasn't country specific. And what the substance of the arrangement was in terms of the way the interpretation committee looked at it was, both parties are registered participants in this market. In the first instance, they contract with a market operator, which Australia generally has, to receive electricity at the spot price. And over that, they've got a virtual PPA between the parties, which is essentially a net cash settled. In other words, in order to settle the difference between the fixed and the spot price, they would have a mechanism where they would settle the cash between each other. This is pretty common. We see them all the time. They'll have lots of other variations on a theme of this. But instead of jumping straight to, I have a virtual PPA, this must be a derivative, I've got a hedge over all my PPA, therefore I'm in hedge accounting, I'm in the financial instrument standard, the first question really should be, do I actually have a lease in here? Because am I not just taking everything from the wind farm? Is it mine? And does that mean really I just have a lease over the facility, over the wind farm itself? So that was the question. Jumping to the next slide, in terms of the way the interpretation committee approached it, they did exactly what you're supposed to in the standard. They broke it down into components. They then assessed whether there was a lease. And so the first thing was they went to the lease definition and actually said, well, in order for you to have a lease, you really need sort of three things. You need an identified asset, You then need to understand whether the customer actually has the right to obtain substantially all the economic benefits from the right of the asset during the period. And then also, as a last question, is does the customer or supplier have the right to direct how and what purpose the asset used? Now, lots of theory there, but it's basically boiling down to apply the lease definition as it was written. First of all, can you identify an asset? If you can identify an asset, define then what the economic benefits are, which in this case is the electricity and the byproducts being the certificates, the renewable certificates that come with it, and then start to understand the arrangement, to understand whether the customer has the right to substantially all those economic benefits through the period, and then you move on to who directs the asset throughout the period. And in this sort of thing, the interpretations committee applied their mind, and from their point of view, they noted that the primary output and the byproduct was clearly identified; those were the economic activities. But the agreement that existed really was a series of contracts where the retailer was involved in, um, essentially for the delivery of and supply of electricity, but it didn't actually convey the right or obligation for the retailer to obtain the electricity output, the primary output. Yes, it got the byproducts, but actually we were transacting in the first instance with the market operator, and really this contract was really just a virtual power arrangement where we were settling essentially the pricing mechanism. So call it a treasury transaction. So they came to the conclusion that this wasn't a lease. Now, I don't believe you can apply every contract that sounds similar to this conclusion. Obviously, there's a lot here that can be applied to a lot of contracts, but the purpose of us putting it into the presentation at this point was to demonstrate that you need to do an assessment of whether you have a lease first and foremost. That's the first key decision. And this interpretation not only gave us a framework to approach that, but also indicated to us clearly, go and have a look whether you have a lease. You need to answer that question before you move on to some of the other questions. If we had a direct provision of electricity to a customer, so for example, a physical PPA, let's say in a wholesale market, or a net pool type electricity market, the answer might have been very different here. And by the way, I have seen, peppered all over the Australian landscape, I've seen wind farms right next door to large-scale steel productions where there is actually a net pool type arrangement where the interconnection between those facilities, all the offtake is actually going across the road from the wind farm to the heavy industry. So you could end up with a very different answer very quickly in Australia, purely based on the relationship between the parties, how the market is operating between them, and also whether there's actually a physical offtake aspect to the arrangement. Now, in the interest of time, I'm going to say at that point, once you've worked past your lease determination, you then move on to some of the financial instrument type considerations, which Dean will pick up.
Thanks, Kevin. Yeah, that's really helpful. And I think the mindset that you apply to looking at this situation, looking at it first from a lease and then moving your way through is helpful. I think when people jump immediately to the notion of the embedded derivatives, they could potentially be missing what's actually happening behind the arrangement. I'm a big fan of context. I think context is really, really important in understanding these arrangements. And because of the nature of the multi sort of leveled aspects of purchasing power agreements, I think it's really important to actually ensure that you do step through it logically. Otherwise, you can get to a conclusion and you might feel that conclusion's sound, but you might have missed something in the entire process, which is more relevant. So I'm going to look at just the PPAs and the embedded derivatives now. So we've walked through it. We've looked at a PPA and we've said, look, it doesn't have a lease. We can't see a lease. Talking about embedded derivatives, the best way to contextualize an embedded derivative, you get derivatives whenever you have three sort of characteristics. One characteristic is where you have a choice between a price and a market price. So if you've got a price that you can use and a market price, that optionality potentially creates an embedded derivative. The other thing you need is time. And so the capacity of that choice to be valuable over time so that the market price changes relative to what maybe the fixed price you have. So in any circumstances, in any contract where you've got those two features, you potentially have an embedded derivative. Now you can actually have an embedded derivative within a lease, within lease payments. So they're not inconsistent. So you could actually decide, well, yes, I've got a lease plus I've got an embedded derivative in that lease. But if we walk through it and we decided we haven't got a lease, then we're working through to basically say, does the pricing arrangement create an embedded derivative? More recently, the IFRIC in June 2023 looked at this fact pattern. So company enters into a physical PPA with the operator of a wind farm that provides the following. They're going to acquire a fixed share, so a fixed share of the production, at a fixed price over the term of the agreement, so 25 years. So immediately, that fact should twig you to the possibility that now we're dealing with potentially an embedded derivative. The operator doesn't guarantee minimal levels of electricity supply, but provide probabilities around production. The company's electricity gross needs far exceed the quantities anticipated under the PPA, but there will be mismatches from time to time. So obviously peak and off-peak. Electricity is not supplied directly to the company, so it's fed into the grid by the supplier. The company has no feasible option to store excess energy when produced, so it's compelled to sell energy that can't be consumed immediately. And again, these are the sort of fact patterns that then lead to the potential for the derivative by the fact that now the entity presumably, because of the contractual nature of the arrangement, and really it's to do with the underlying features of electricity, the fact that if it's produced and you can't use it, you have to do something with it. And typically what you're going to do is try and sell it into a market. That creates, and with the optionality, that creates the potential for derivative. And so the question was, actually, is this a derivative arrangement? Really what they're actually asking is, notwithstanding we're going to be consuming electricity, have I actually entered into a derivative arrangement separately from this? Because often with these arrangements, the retail side of the delivery might be done separately from the actual contract for difference. So if we roll down to the next slide there, the PPA embedded derivatives, the findings, the key part of this, and I mentioned, I sort of alluded to before, is that in IFRS 9, there's a set of criteria that talk about your own use criteria. So it determines, there's an exception that if you are in a contract, and there might be some pricing flexibility in it, but if you're in the contract purely and solely to take possession of the underlying supplied good, you could argue that it's not a derivative, notwithstanding that you have the ability to choose to either take the good or perhaps settle net. The problem with this criteria is that it was written probably a long time before PPAs come into existence, and so it never really contemplated the possibility that in PPAs, because of the nature of the good, that we have to take it or sell it. We don't have a choice of just taking it and holding it. That you're going to have net settlement features within PPAs that are just natural features of them. So as a consequence, when the standard setters looked at this, I said, well, actually, we've got this criteria. The criteria is what it is. It seemingly applies to these types of contracts, notwithstanding that it doesn't necessarily or may not have been written with these types of contracts in mind. And so the argument then was, well, okay, how do we interpret this criteria in light of the practices around PPA? So particularly, does delivery encompass both direct delivery and delivery via the gross pool electricity market? So do we say, okay, the fact that the good is not being delivered directly to the consumer, does that mean that it's always going to be a virtual PPA? Or do we say, look, can PPAs ostensibly held for own use, but with some net cash features, some net settlement features be accounted for as executory contracts, so just as typical supply contracts? And if so, when does it become a derivative? So how often do we have to net settle to make this thing actually a derivative rather than, and make it a virtual PPA rather than a physical PPA? And the interesting thing is, and these are coming out of conversations I've heard in the last couple of weeks too, where people are talking about the impact of true-ups. So sometimes and again, the criteria here had been written with the idea that there's just two parties, but when we start to think about electricity markets, there might be multiple parties, and you might have to, certain parties might act in certain ways at certain points, and as a consequence, you might have to get ultimately true-ups. Not because necessarily anybody is trying to game the market or trying to make profits on the prices. All they're simply trying to do is make the market work. So sometimes people have to pay in advance, maybe have to work out later what exactly has been consumed. As a consequence, there's a true-up process. Now, the criteria in 9 don't distinguish that kind of net settlement feature from any other net settlement feature. So as a consequence, then you basically have to say, well, these criteria, unless we rewrite the criteria, it applies and we have to then account for it. So that was what the IFRIC were really dealing with in this sort of context, is trying to understand, okay, does this criteria get us to a solution that works, or does it actually create a problem, or does it, is it need to be, adjusted or interpreted in a different way? If we move on to the next couple of slides, And that IFRIC decision was effectively the sort of the impetus to some of the changes we're going to talk about in a minute. But I just wanted to make sure that everyone sort of had an understanding of the physical versus virtual, because that's part of that key aspect. So with a virtual PPA, you are physically swapping. Someone is actually physically taking electricity and paying for it. Now, typically, there's always going to be a retail aspect to it. There's usually going to be a retailer underlying the supply. But as a consequence of that, there will be some aspects that are, that are sort of effectively contracts for differences. There's a neat little, I found this a neat little description basically out of our recent BDO International Global publication on nature-dependent electricity. And it does give this really good example, sort of explains how the flows go. We might roll through those because they're there for people to look at if they want to also get the BDO Global publication. If you look at the virtual PPA, you can see it's almost identical except for the fact that there's some sort of netting out of payments. And that's probably the key difference. And I suppose this is the difficulty that the standard setters are facing, saying, well, often when we look at net payments, we don't usually put a lot of emphasis on them. So how do we make a distinction between a physical PPA and a virtual PPA? Or do we just want both those PPAs to be treated the same? Because we just don't make a distinction between them. We move on down to the PPAs, embedded derivatives, the power purchases project. Now, the ISB has been conducting, it was a relatively quick and rapid fire assessment of the situation. So the issue was raised about the embedded derivatives and whether or not, there'll be some PPAs, depending on how they're treated, they'll be own use, but there were some that might be derivatives. And so the industry were feeling, look, there isn't a clear approach to these. We feel that with virtual PPAs, yes, we think they're definitely embedded derivatives and should be treated within 9. However, physical PPAs we think should be treated as supply contracts, but the trouble is making the distinction between the two things within the criteria in 9 is really hard. So can we get some guidance or can we get some explanation? So the ISB went to work on it. They identified what the issues was. They have just recently issued their contracts referencing nature-dependent electricity amendments in IFRS 9. And these have primarily addressed those nature-dependent CRNEs, okay? And so making clear that how the own use exemption works, but also explaining how hedge accounting works. And I'll come back to hedge accounting for a minute, but to just explain, so CRNEs are defined in the amendments to IFRS 9 as contracts that expose an entity to variability in the underlying amount of the electricity because the source of the electricity generation depends on uncontrollable natural conditions. So effectively they're weather determined. Now, as you can see immediately, is the ISB is minimising the scope of this just to those particular contracts that are PPAs and relying on renewable energy. They're not talking about ones that necessarily be driven by brown coal, black coal, any of those sort of things. It's all nature dependent they're talking about. So if you're thinking that your PPAs are caught by this, make sure that they're actually, for a start, that the energy you're acquiring under those PPAs is from a renewable source, so from solar or effectively wind. Moving on to the next slide. Interestingly, in our BDO publication, it was useful. It's also a useful one because it actually, being global, it's picked up on the sort of some of the subtleties and the different arrangements that exist across jurisdictions. And so identifying, one of the key things it identifies is that there are lots and lots of different types of contracts out there, but underlying that, if they are for renewable energy, they're potentially caught by these changes in the standard. If they're not related to renewable energy, irrespective of the shape of the quantity or the pricing of them, then they're not going to be caught by the exceptions. And so therefore they're going to be still treated effectively, if they've got net settlement features, they're going to be treated as derivatives. BDO Global made some really interesting observations in it, and I've listed those there briefly. I'll quickly run through them in the interest of time, but basically identify that if you want to be within the scope of the requirements, the key criteria is outlined in that BC 2.7 and BC 2.8, which include, so the contract must require the entity to buy and take delivery of electricity when produced. The entity is exposed to, and I'll stop at that dot point for a quick sec. The contract requires the entity to buy and take delivery of electricity when produced. It's not necessarily electricity from the provider. It could be electricity from the grid. So it doesn't necessarily preclude the gross pool, contracts within the gross pool necessarily being treated as physical PPA. So second dot point there, entities exposed to risk, it will have to buy electricity at times when it cannot use, and obviously that's again tied to the renewable aspect to it. Entity has no practical ability to avoid making sales of unused electricity because design and operation of relevant electricity market require unused amounts to be sold within a specified time. That's interesting because what the standard setters have also done there is open the opportunity that they're not simply saying that if you can battery save this electricity, that you will necessarily be able to or will be kicked out of these exceptions. What these criteria are saying, actually, if the market doesn't have the facility to deal with it, then effectively you can still treat these, or you can still apply these exceptions to some of your PPA. And the last dot point there, entities being and expects to be, based on reasonable supportable information over a reasonable period of time, a net purchaser of electricity. So the idea is again, demonstrate by your actions I'm a net purchaser. It means that I'm not playing the market, basically net selling, net buying, and as a consequence, I might end up with actually, selling more electricity than I've actually bought. Moving on to the next. I think we might skip that poll question. What do you think, Aletta, for the time being? Just in the interest of time.
I think it would be interesting to get a bit of feedback
No?
quickly
You'd
if
like a
we
bit of
hear
it? Okay.
yeah.
Okay, let's do the poll question. So the poll question is, do you think you'd meet the criteria in BC 27 and 28 to qualify for the own use exception? So I'll just run back through it to make sure. So while people are thinking about it. So the criteria are, you've got a contract that requires the entity to buy and take delivery of electricity when produced, that you are exposed to risk, and it will have, you're exposed to risk, you'll have to buy the electricity at times when you cannot use it. So that might be in the case of when you, on weekends or necessarily on weekdays or nights. The entity, that is you, have no practical ability to avoid making sales of unused electricity because design and operation of relevant electricity market requires unused amounts to be sold within a specified time. So it's not a case that you do or don't have batteries. It's just that you don't have the capacity within the market to sell back. And you've been and you expect to be into the future a net purchaser of electricity for the contract period. So you're going to buy sufficient electricity to offset any sales that might be the case. I'm just looking at the numbers, an interesting split at this stage. So effectively saying 1/3 of the listeners are actually saying that they will be able to be caught by those exceptions, whereas 2/3 are saying no. So that's an interesting finding. If we move on to the next slide, later the accounting for CRNEs, I thought that was an interesting set of observations by BDO Global, and I think it's quite helpful because up to this point in time, we've been hearing some interesting conversations around what these exceptions might do and how they might be applied going forward, particularly with changes in the market. And the interesting thing that the AASB have, or sorry, the ISB have actually have identified is saying that we think that, for example, the effect of risk mitigation features such as contractual caps and floors, we don't think necessarily that precludes you from basically applying it. The idea is that notwithstanding you might have a cap or floor, and it goes back to what Kevin was saying before about context, the effect of that is to say you could have variability within that cap and floor. It depends on how high or low those caps and floors are set, and so as a consequence, whether or not you fall within them. So effectively, there may be variability. If in substance there's no variability, then you might argue that those caps and floors are not relevant. Alternatives to selling electricity, I mentioned before the idea that it doesn't contemplate batteries changing these exemptions necessarily, but it does ask whether or not if there's a market change, and I mentioned later perhaps that the idea that batteries or storage facilities now being attached to the grid might also do something to impact the effect of these exceptions. And the assessment of the net purchaser requirement, it has to be done basically on a market by market basis. So you can't necessarily sit there and say, well, I'm a net purchaser over all markets that I'm involved in, because you are only buying and selling into individual markets. And so as a consequence, you can't make that judgment at a global level. Aletta, if we move quickly through to the hedge accounting, I think the hedge accounting is an interesting one to the extent that what it does is gives an exception to entities now. Now, if we think about what we're dealing with is, so entity has got a hedged item, which is purchases in the future, so forecast transactions in the future to buy electricity, and they've got a hedging instrument in the form of the PPA. Now, typically, we can't hedge the nominal amount of a variable hedged item. So we can't usually we have to designate a certain amount on inception of a hedge arrangement to identify it as the hedged item. Now, when we enter a PPA that might be sourced by renewable energy, we don't know exactly how much we're going to get. it could be variable. So as a consequence, we can't actually put our hand on our heart at the inception of hedge accounting in this situation normally and say, that's the hedged item. But what the exceptions now do is effectively allow you to do that. And you're allowed to do it by virtue of what your hedging instrument says. So it's an interesting decision. It's an exception, a real carve out by the ISB, and it's a real exception to hedge accounting. Now, hedge accounting is usually, it hasn't changed much in probably 10 years. There've been some changes when obviously when 9 was adopted, but this is quite a significant change and quite a significant exception. So obviously the effect of this renewable energy question was really hit the ISB closely, and so decided they wanted to make these changes. They thought they were significant enough to create an exception in the typical hedging accounting arrangement. I might skip straight through, Aletta, if we can, straight just to some of these anticipated developments. I think I mentioned before the impact of developments in batteries and storage capacities. It's undoubtedly going to change the capacity for entities to manage their electricity use and consumption, but the exceptions as they're currently phrased don't seem to indicate that will necessarily preclude entities from applying those exceptions if they have good battery storage. We'll see exactly what the ISB thinks probably going forward if and when batteries become more prevalent, but certainly if large-scale storage arrangements within the grid become available, then we would expect to see that the exception would be less available for use by various entities, particularly around those renewable energy contracts. One thing I've seen, and as a few of us have seen, is the monetisation agreements around carbon credits. So often entities that are generators of carbon credits, we are seeing that they're now starting to contemplate how can they monetize those, but monetize them upfront. So the idea is actually sell the stream of future carbon credits to another entity, so they can ensure that they've got their carbon credits and effectively the seller is getting some cash up front. We're not seeing a lot of those, but we are starting to see them starting to appear here and there. Obviously, they're challenging to negotiate because obviously you're talking about a lot of uncertainty into the future. But there's certainly some interesting aspects to the accounting to those, whether or not we're talking about derivatives, whether or not we're talking about liabilities, whether or not we're talking about maybe even talking about revenue potentially. And some new products, we're also seeing some evidence of storage facilities being attached to the grids, which obviously is going to change if companies' abilities to obviously manage their consumption, but it also creates some issues again, whether or not there's actually leases being created here. So if the capacity to use those batteries as they're attached to the grids is being sold to another party, and another party is able to then choose whether or not they take in or use electricity from those batteries. That takes us back originally to Kevin's discussion in the first instance about leases and about whether we've got actually a lease in that situation. So I think that takes me right through to the BDO resources, Aletta.
Thank you very much, Dean. I agree with Kevin that was a really amazing overview of what we're dealing with here. Dean, I did think as you were talking, we are introducing a lot of concepts today on how do the markets work, what are the purpose of PPAs. We talk high-level hedge accounting, derivative leases. I really think what would be useful for the webinar attendees is how does this turn into journal entries and practical outcomes? So, what do the different alternatives result in, and what are we going to see in financial statements, and what will disclosures look at? So I think as a group, the three of us should take away how do we make it real. So I think it's really important that today we set the scene for this. But definitely, I think a takeaway is how do we make it real? But that was fantastic, Dean, explaining the background to it. Really good. So thank you for that. I think on the BDO publication, I've included a link to the publication. And then I also, thought it is important to flag what is the process in Australia. So in December last year, the IASB issued the contracts referencing nature-dependent electricity, the amendments, and it made amendments to IFRS 9 and IFRS 7. If you're interested to know what's the status in Australia, on the 12th of February, the AASB issued similar amendments, and I've got a link there to the amendments in the Australian context. So sometimes there's a bit of a delay. This has actually happened fairly fast, So there's just some information for you to have a look at. Dean, I think we call it quits here, but with a promise to our webinar attendees that next time we're going to start with accounting position papers, because I think this is a really important thing that we should address before we roll into 30 June reporting season. Next week, we're going to talk about leases and some of the complexities and technology and potential solutions. But before we do that, I think it's important we talk about accounting position papers. So please, I know there will be a bit of disappointment around accounting position papers, but we'll pick it up at the start and next time. And Dean's put together some really interesting slides that I couldn't wait to listen to as well. So thank you for that, Dean. Just a reminder that if you're looking for IFRS corporate reporting advice, you've got these 6 partners across BDO Australia that can help you. Please reach out. If you're looking at sustainability, which is such a hot topic at the moment, whether it's carbon footprint, sustainability reporting, whether it's more strategic or consulting aspects, please reach out to these individuals as well. And if you're thinking about sustainability assurance, a number of partners that would love to work with you. Finally, Dean, Kevin, thank you very much for the webinar, for sharing your insights. Already looking forward to next month's one. Thank you very much and have a good day.
Bye.
Thanks, Lida. Bye.